Good evening, everyone. It is Shooter Scott Henderson. We're going to go over swing trade notes today. Of course, trying to take a look at what our setups are into next week, or what we think looks well or looks good. Of course, at the end of our presentation, please do review our disclosures. Okay, now, last week we had Hurricane Beryl, or I had Hurricane Beryl, and screwed my entire week up. Actually, I think it's the first week for the year we actually took a loss. So, wanted to do something just a little different to mix it up today, only because I feel like I'm coming back. It's like January 1st for me. That's the way it feels. So, typically in any type of shooting event or assassination, certain stocks do well. So we drilled down and we took a look at those to see what counts look very good or looks promising. So in other words, we expect the fear to be built around, all of these, whatever events we want to call them, whether they be insane people trying to kill us or they are true assassination attempts with some form of a mask. I mean, I don't think any of us know, but there are known outcomes when this happens because ultimately people go make sure they have enough bullets. So, General Dynamics is one that typically responds to that. Right now, it is a 50% back candidate with a swing target of 291. Now, a lot of the spreads were horrible already, which, implies that everybody already thinks this is going to run, by the way. So the August 290 calls were the only ones that really did not have a horrible 60+% spread, which means you're upside down going into the trade. And I didn't like that. So I'd rather pay tighter in and make sure I don't have that spread. So that's my thought. So, the setup in my book, you're going to decide whether you want to take this trade first thing in the morning, wait for the first 5 minutes, the opening range to be set, let the premium get vetted out of those calls just for a minute. So you want to be stalking them right at the open. And then you're going to decide if you're going to take this trade, because ultimately how it's going to work. All right, the second piece that really is the same trade. Bottom line is we all get uncomfortable when there's something like an assassination attempt, because it's an unknown. We don't know what the outcome is, but we want to make sure we're protected. And that's really what this is. We want to make sure we take all precautions we can to take care of ourselves. So NOC, Northrop Grumman, is the next one. Another 50% back candidate with a target of 450, 460. Now, the August 435 calls were the only ones that I really liked because I want to stay really tight on this one, mostly because of this look. I didn't like that flat look, but it still has a decent upside, 50% back if it decides to run. I would not be surprised if this doesn't gap in the morning. That is, actually, I hope it gaps a little bit, just a little bit. Just puts in a little wick right above this candle right there, and boom, that's your buy entry. Okay, same scenario. Now we're looking for, 30, 50% on these trades. Don't be, greedy with them. You hit your numbers, take your profits, and let's go to the next one. So RTX is the next one. A little shallower, except I do not like this one unless we get back down to $100, which is only about $1 lower. The spread, the range was tight enough. We're only looking at about 103, so I really don't want to enter at 101, but $100 I do. 50% back. We don't have a lot of room here just because of the look of that pattern. So about the only option is September 110 calls, which probably we will not hit price. So I'm thinking we get to that 103 and it's probably a 25 or 35%, somewhere in that range. Gain max is my thought. I don't see a lot of upside in this. But again, it was under that same theme of a shooting or an assassination attempt, typically what stocks move. Now, my favorite chart, and I've been stocking this, been stocking it, missed it. I don't know why I didn't take it into this gap. I don't remember, but it's been on my list for a while. So we rejected price right in the middle of the gap, went down, put in a higher low. So, we had our confirmed low, and then we got our divergent low here. High and tight, which I really like, which is, again, why I must not have been watching it, because I would have loved to have taken that here. So I think we head back towards this 77, so 50% back, 77, 79. Not a big move here from 74. As a matter of fact, it might even gap into that number in the morning. August 75 calls, that we really didn't have anything as a higher strike. Like I'd love about 77.50, but we didn't have that as a strike. And the August $80 call, There was a decent spread on the August 80s, so I didn't like that as much as I like the September. But if we're at, 76 bucks, your only option is to go with the 80s if we gap into the open. But I think this gap gets filled. I think fair price on this is 85 bucks from where we are now. And according to the count, we've got a target wave 3 up around 90.90. So this, to me, Starbucks becomes a position trade down here. Yeah, I mean, could very well, even though I don't believe it's on the plug and play. And Roscoe, that's enough. And then I had to wait for him to finish to give him instruction. He doesn't listen when he barks. All right, so either case, I like Starbucks was my favorite looking chart ever. Everything I looked at. Now, last week we posted target the moments that I had internet. The internet was in and out. I'd get it for a couple hours and then I'd lose it. Posted it in chat last week. Like the setup. I mean, it basically ran $1.50 really quick from there. Right after I posted it, we have this gap fill that we filled, rejected price, came back and tested the lows. We put in just a tad bit lower low at 139.38. So this was our 2. This became our 2. So if you look at the RSI, we have a confirmed low and a divergent low. And, when I was looking at this on this low, that was what I was thinking, is that this is going to go into the gap, get rejected, and put in a lower low, was my thought. And we got that. Now we've got a decent back test with a higher low here. It is now broken out from this pattern. So I'm looking for continuation. 50% back of this entire ABC pattern is 160.52. I like the August 155 calls. Again, I'm going to stay tight. All right. Now, stay tight or reduce position side or all of the above. Reason being is I think the market's getting overbought to extent. Even though we had a decent pullback in tech, it wasn't that significant because it was very select. It was almost like the funds stopped buying tech. So, where we had that buying momentum that was, in the rotation that was going in, it's like all of a sudden they decided to sell. That is not the type of corrective leg that I think we might get here. I'm thinking when we get to our primary wave 3 or primary wave 5, depending on the index that we're looking at, there's, like, for example, the NASDAQ has the potential of a $35 correction. So the only way that we can start mitigating at this level, we've been in this, we've had a long run here. Even though I think a 50% rate cut is going to really oomph the market. So we're going to have that at the end of this month, 22nd. Actually, I'm horrible here. I'm so disconnected with not having internet so long. FOMC might be the 22nd. No, it'd have to be the 28th or 29th. So it'll be not this Wednesday, but next Wednesday. And, once that comes in, if they cut 50 basis points, stocks like TLT and the next LQD, which I'm going to go over in a minute, will be something that'll get a pop, like $3 to $5, $8 pops off of that 50% or 50 basis points rate cut, because I don't think they do 25 basis points. I think it's because they're fearing the job market is going into recessionary territory and their objective is to stop that, all right? Because that's sort of what the data has been telling us. So our target again is 160. We like the August 155 calls. So again, what my suggestion is that we scale, right, and reduce position sizes a little bit over the next couple of weeks, just out of caution, all right? And obviously know what you own, what you have, obviously looking at RSI, if you have a divergent higher high, you want to be trimming. If you have any questions about those stocks in chat, please feel free to ask. Now, LQD is sort of an outlier for me this week, sort of on that thesis of a 50 basis point rate cut, just like TLT. I'm considering both of them a lotto. What I mean when I say a lotto, if they work, we make money. If we don't, we lose all that we've invested in. That's ultimately my definition of a lotto. So our target is about 118. And our difficulty is getting far enough out where you're not paying a fortune for these. We're at 109.17 as I print this. The September 120 calls were the only things that made sense. And that pretty much is it. So I'm going to suggest that maybe we scale into that if you're going to take on this trade. Now, I just wanted to spend a second and go through, my thesis, my theme, a little bit with Elliott wave and Fibonacci extensions and how I use them. And, ultimately, I'm focusing more and more on the 50% back structure than any other trade setups because I found it to be the most consistent way to win. And I can typically win well over 65 or 70% of the time with the setups that I give you. And, we can consistently make a few bucks on it. The game is 30 to 50%. The majority of them, once in a while, we'll get a runner where we get, 150, 200%, whatever it might be. And then we want to work on capping weekly losses to no more than 25% of our gain. So once you take these, so let's say, for example, you take all 6 of these entries this week, and you are now up 50%, right? For your week on what you've invested in these trades. Your risk now is you do not lose more than 25% of that gain, period. Or you're trimming, okay? And that's your management. And that you want to do on a weekly, monthly, quarterly basis. That's the way I manage my risk. I think it's one of the most fabulous ways to manage risk. That way, when you get the upside, you're not necessarily trimming your runners, your winners, until you get some divergence, coming down to the 4-hour. You get divergence on the 4-hour, you look at the daily, you look at the weekly, you make some decisions on how you might want to trim when you have a divergent higher high. Otherwise, hold, all right? If you're in an account that's structurally not positive for the time frame of your strike or your option, then at that point, you want to trim as well. And typically when I trim, I'm trimming 25, 50%, 75%, and then I'll leave some runners when a trade has worked perfectly. But most of the time, I'm not even leaving runners in this market because it likes to give it back. I mean, there is absolute no doubt. And LQD is a great example. We had this wonderful run up, and what did we get? We got this flush. Gave more than 100% back. If you held into that, it didn't matter what your gains are. But if you trimmed, you might have ended up flat or even a little profitable. And that's the game plan. So consistently, we want to do the same thing, manage our risk once we're in the money. And I don't look at that I look at it in blocks. I want to look at my options trades. So my long option trades are in one block. My short options trades are in another block. My scalps are in one block. My position trades are in another block, and they're broken down by sector. So I want to make sure that I manage risk by sector in my position trades because we tend to have this rotation in and out of sectors. And I've learned the hard way so many times. I can have 3 or 4 runners in a sector, and all of a sudden rotation comes out of that, goes out of transports, goes into consumer staples, and bam, you're down and you have no gains. You just sat there and let your gains evaporate. And that's not the name of this business. And unfortunately, the market really has become a stock picker's market. So if you're good at picking stocks, you're making money. If you're not a good stock picker, and you can even be a good fundamentalist and not make money in this market, which is one reason Kirk continues to impress me. He does a great job at what he does. I mean, we complement each other tremendous. And obviously, I'm trying to help you guys stay in those names for as long as you can, and continue to book some profit. And this has been an extremely challenging quarter. When really all of 24 has been because we've been overshooting to the upside, which is very, very difficult because those back tests, we're not getting the follow through that we need. We didn't get that exhaustion or that seller exhaustion that has occurred in many cases. They were just blips to the downside, really no structure to many of them, and then bam. If you were a bad stock picker during that period of time, you probably ended up being upside down. And to be honest with you, I would not be surprised if some of you do your own work that you're not flat to a little bit red for 2024 because it's been that challenging a market. So maybe you're taking a number of Kirk's growth stocks, you're playing these stocks, and then you're playing another staple structure that you've been buying because you think it's been stable. And ultimately, your balance at the end of the day might be upside down. And then there's other ones of you, I won't mention those of you that I know, that are up 400% for the year because you were a great stock picker. Okay. So, again, we want to manage our position size more in this period of time with this elevation in the indices because we want to make sure that we retain those gains. We don't want to give them back. And with that, I'm going to end. Great trading, folks. Until next time.